We now discuss one of the important parts of insurance management and planning, which is how much insurance should someone have, how much should be the magnitude of the insurance cover. So how much insurance is adequate? Now, logically higher the better, because when we're looking at life insurance, essentially what someone wants to kind of ensure is that their family does not have a problem in case something goes wrong, right? But there is a cost attached to it. And what is the cost? The cost is the premium you're paying. The premium you're paying versus the sum assured is what you are basically looking at. So the question we have to answer is, how do we arrive at a logical sum assured for an insurance policy, right? What is the amount that someone should be insured for? Now, this is one of the most critical questions in risk management in finance and wealth management, and we're going to look at the calculation methodologies that the industry typically deploys, or if you could say so in terms of the overall calculations. How do you arrive at the broad number, right? So there are broadly three methods that are used, and all of them basically use what is called as the human life value approach. So it depends on the value, the value that can be attached to the human life, right? Because at the end of the day, it is a life insurance, and the cover you're requiring is for what is the value of the human life that is not there. This is the value of insurance that needs to compensate if there is a loss of life or disability that results in the income generation problem, right? And it's the present value of expected income over the working period of the life of the individual that is available for the dependents. Now, think about it this way. There are going to be multiple ways you can calculate it. Typically, the way the industry uses it is there is going to be a broad thumb rule that is there. So a shortcut method where you can quickly calculate, okay, what should be the broad insurance cover for someone. Then there is going to be an income replacement method where we are going to primarily apply the tenets mentioned in point 3 here. And then there is going to be a need-based insurance where we are going to take individual insurance components for each goal that a person has, each need that a person and his family have, and then over a period of time we find the present value of those and we add up all that. So need-based is the most evolved calculation that we will see. It's the most complicated calculation that we'll see. It's not complicated as such, it's more complicated than the other ones that we will see, right? So now let's try and focus on the methods to calculate this. The broad thumb rules that we will see will include broadly a certain number of years worth of income for a person, or a certain number of years worth of household expenses plus any liabilities, right? So let's take the first one, which is a certain number of years worth of income. Typically, we use something like 10 years worth of current salary for the amount of insurance cover. So if the current salary for someone is 12 lakhs, you will just multiply that with 10 to get 1.2 crore of the insurance cover or sum assured. That's what you will look at, right? So effectively, that's the broad cover that that someone would want in the case of the income method. Right now, we could also look at household expenses plus any liabilities. Let's say household expenses are 6 lakhs a year, right? And you want it for argument's sake any number of years. We can take that for, let's say, 10 years again. That's 60 lakhs. And let's say there is a home loan. So that's the expenses. And there is a loan, a home loan of 50 lakhs. It's important to cover any kind of liabilities. So that's 110 lakhs or 1.1 crore. Using the second method, you arrive at 1.1 crore of insurance cover. Right now, understand that this coverage of a liability is extremely important, Because in the case of loss of life, a person surely does not want his or her family to have any problems in repaying something as basic as a home loan, right? So typically when someone borrows home loans for buying a home, it is almost immediately attached to an insurance as well. It's great to have an insurance covering that specific amount of home loan right away in case there is a sudden demise of the person. It is always useful to cover that, especially in the expense-based approach that we are looking at, right? So expenses, some years worth of expenses, this years could be 10, 12, 15. There's no hard and fast rule. Depends on how much comfortable a person would want to be. But this plus any kind of liabilities that you have, you add both of these to arrive at what kind of broad insurance cover someone might want to have, right? So either a certain number of years or a certain number of years worth of household expenses plus any liabilities that the person has. So that's the first rule, which is a broad thumb rule on how do you go about calculating it. The second could be insurance based on income replacement. So this is the present value of the person's future earnings. This is a method to calculate amount of life insurance that a family will need based on the income that they would have received, right? And they would have to forego in the case of the unforeseen event. They would have received the income otherwise, but if they forego that, then what happens? So in this case, there are a lot of factors that you have to consider. You have to basically look at average number of years that an individual is likely to earn. You have to look at average annual earnings during the earning years. You can look at some of the data points like taxes, personal cost per insurance premium, etc. You have to look at the rate at which the income is expected to grow over the earning years, and you have to look at the rate of return expected on the corpus. Let's take an example, and that will explain this and make it simpler for us to understand this method, right? Let's say there's a person, Mr. X, who earns 10 lakhs per annum. This person is 34 years old and would like to retire at the age of 60, correct? The insurance need as per income replacement method has to be calculated if we assume that income would have gone up each year by 5% and investment would have earned a return of 8%, right? So the first thing we have to find out is for how many years this guy is going to work. That's 26 years. Retirement age is 60. Investment return rate is 8%. Income is going to grow at 5%, which means today it is 10 lakhs. Next year it'll be 10 lakh growing at 5%, right? Let's try and calculate the insurance cover needed. So on our Excel file, we realize that there's a salary growth number here, and we are going to basically look at the number of years that the person is going to live. So that's here, 26 years, correct? Now, today's salary is 10 lakhs. So next year's salary would be 10 lakhs multiplied by 1 plus the growth rate in salary. That's 5%. And we double click it. So that's the overall salary stream that the person has. This is the entire amount of salary that the person would get if he were to continue working for the next 26 years, correct? Now, if let's say the person is not there, in which case this entire cash flow stream or salary stream is not going to come to the family. That's the requirement that they have. And they need to have a certain amount of return that they can generate on the corpus that they get today. Let's assume that is 8%. We'll assume it to be in safer instruments. It will go and sit in 8%. So effectively, all we are doing is we are calculating the net present value of using the rate of 8% of this stream of income, right? Net present value at 8% of this stream of income, which gives us a value of 173.1 lakhs, right? So effectively, if the family has 173 lakhs today, invested at 8%, they would generate the same amount of income for the family every year. correct? And that is where the key calculations would come in, right? So effectively, this 173 lakh should be able to give the same earning stream to the family, assuming an 8% growth rate on the overall corpus. We can also check that, right? Let's say the family has 173 lakhs today. We are assuming that all these numbers are being taken out at the end of the year. So they have 173 lakh today. This, we're just rechecking this. This grows at 8%, correct? And let's freeze 8%. At the end of the year, you have 187. From this 187, you take out 10 lakhs. That's because it's the end of the year. You take out that amount. And then this number also grows at 8% over the next year. And then you take out from 191, you take out 10.5 lakhs. And then this number grows at 8% and so on and so forth, right? So effectively, we are taking this down all the way up to the final 26th year and the final year. So at the end of the final year, you have 34 lakhs, 33.9 to be precise, and you take that out, you're left with no corpus. So effectively, you have replicated this earning stream by investing 173 lakhs today at 8%. So if we can look at it, the broad insurance cover that is required based on our calculation that we have just seen is 173 lakhs or 1 crore 73 lakhs. It depends on a variety of factors such as what is the income growth rate. Income growth rate increases, then of course you are foregoing a bigger earning stream. So effectively you need a bigger insurance to maintain the same quality of life, right? That's basically the amount. Obviously from this amount, you will subtract any existing corpus that a person has. So we arrived at a number of about 1.73 crore. If the person already has an insurance or saving of, let's say, 40 lakhs, then the actual cover required is 1.23 crore because that 40 lakhs is already available, correct? So effectively, that is how we go about evaluating the present value of the income stream that a person will have at what is the expected investment return rate that someone would have after the money is available to them. And as the person lives every year, there is going to be a certain amount of saving. This number, remember, is going to increase. So once this number increases, the overall insurance cover reduces, right? That's our earlier discussion on how insurance cover gets matured. This is the second method, which is the income replacement method. Now we move to the third method around insurance calculation, which is the need-based analysis. Now this method of calculating is based on the amount required for the needs and goals in the event of demise of the earning member. Needs and goals could include basic expenses, mortgage expenses, rent, loans, medical expenses, college, expenses for children, education expenses for children, marriage, any kind of emergency funds for the family. You're basically looking at all the goals, right? So you have to consider the needs and goals that have to be met and their current value, inflation rate applicable. Why is that? Is because college education today might be 10 lakhs, but after 15 years, the number might be something else based on inflation. The current value of available investments that are there and the rate at which investments are expected to grow. We may also use a laddered approach for insurance here, which means higher insurance in initial years but lower later. Let's broadly understand the premise of this. We will obviously do the calculation at some point, but let's broadly understand the premise of this. So the broad premise suggests that you have a person who has multiple goals. The goals could be, let's say, child education, right? Which is, let's say, 10 lakhs today, and at an inflation rate becomes 15 lakhs inflated value, right? And maybe this comes after 8 years, right? You could have another goal which comes after, let's say, 3 years, which is you want to purchase a car, and that's worth maybe 7 lakhs today, but after 3 years, based on the inflation, that might be worth 10 lakhs, right? That's the inflated value. And similarly, you might want to purchase a home after 10 years. You want a home, and the inflated value of that might be 1 crore, right? And then after 15 years, or after, let's say, 18 years, you have child wedding, correct? And that expense is, let's say, an inflated value about 30 lakhs, right? Now what do is we take all these and we find the present value of all these inflated values. We find the present value at the investment return rate. So if we assume that the investment return is 8%, we will find the present value at 8% of all these. We can do that. We can use the PV formula for each of these goals to arrive at the present value of all of them. Once we arrive at the present value of all of them, that is going to be your insurance cover, right? Now that's need based. You've basically looked at goals. You can also look at household expenses over the years and add that to that, correct? That's your insurance cover. Now, more importantly, what is needed is a figuring out of the fact that there could be a laddered approach. What do we mean by laddered approach? If the person survives for 5 years, then the person would have saved, let's say, 50 lakhs already from the current income. So from your insurance, you don't need 50 lakhs. Insurance minus saving, over life, saving increases. So you don't need the 50 lakhs in that context, right? So what happens then is, technically we go back to our initial understanding that insurance requirements increase first and then they decrease. So logically, if the insurance cover is 1.75 lakh crores here, it will not be the same in subsequent years. So let's say for the first 10 years, that is the kind of cover. The next 10 years, that kind of cover is not needed. So usually, instead of taking a single policy saying 175 crore, what sometimes people do is they take a 10-year policy of 75 lakhs and they take a 20-year policy of 1 crore. Correct? So what happens is, in the first 10 years, you have both the policies in place. You have taken 2 insurance policies instead of 1. So total cover is 1.75. But after 10 years, only the second policy is in effect. So you have only 1 crore. And that's fine, because you would have saved 75 lakhs in the first 10 years. If the person continues to work, if the person continues to live, that amount would have already been saved. Correct? So let's try and model this once and see how it works. So for this, we go back to our Excel file and we just say, let's say, expenses that we are trying to kind of build in. So child education, and number of years that we are looking at is, let's say, after 8 years, and the inflated value is 30 lakhs, right? So after years and inflated value, whatever that value is, 15 lakhs, sorry. Then we have a car after 3 years, inflated value 10 lakhs. Then we have a home after 10 years, inflated value is 1 crore or 100 lakhs. And then we have child wedding after 18 years, inflated value is 30 lakhs, correct? Assume the return to be 8%. And we can also assume that annual expenses, let's say, and we need this for 15 years, and let's say annual expenses are about 6 lakhs for 15 years, right? Every year you need 6 lakh rupees. So one way is we can assume that annual expenses are required for 15 years. If you want to calculate the present value, So this is PV of at the rate of 8%, that's frozen. Number of periods that you're looking at is this number. There is no PMT in this case. The future value that you need is minus of 15, right? So you need 8.1 lakhs of cover based on that today. Similarly, you need 7.94 for this. You need 46.32 for this, and you need 7.51 for this. And in this particular case, you're going to calculate the PV based on 8%. The number of periods is 15. This number is PMT. Every year you need this. There is no future value. So the total amount needed is 51 lakhs. And if you take the sum of all these, that's the total insurance cover that is needed, 1.21 crore, correct? 121 lakhs is the total insurance needed. Now, interestingly, if a person lives one more year, then you would have saved 10 lakhs. Another year, you would have saved 10 lakhs. Another year, you would have saved 10 lakhs. So for the next 18 years, 18 years is the longest goal, you approximately need 1.21 crore, but after 3 years you need only 91 lakhs because you would have saved 10 lakhs each of the years, right? And in fact would have made some investment return on it as well, but let's assume we are ignoring that. So technically for the first few years you need maybe the entire insurance, but after that you'll probably need a declining insurance requirement as the person keeps saving, right? That's the calculation in terms of our example for need-based insurance, where insurance needs could be laddered, which means there are two insurance policies. Initially, both of them are in effect, and then after a while, only one of them is in effect, right? That's how we calculate insurance cover. That's probably it in this particular section. A couple of quick questions. Under a thumb rule, how many years worth of salary could be taken as an insurance cover for a person? And why is insurance cover for any liability like a home loan necessary? Thank you.